Well, good morning, everyone. I hope everyone can hear me. Thank you for joining us today. My name is David Roberts. I'm an insurance partner at BDO, and I'm joined today by my colleagues, Alex Barnes, Mark Spencer, and Santiago Restrepo. The first thing I want to say really in this odd times is that we all at BDO hope that you and your respective teams, families and loved ones are safe and well. Before we start the substance of the morning, I wanted to touch on some housekeeping points. Today's webinar is going to be recorded, and we will circulate the slides and the recording in a few days' time. During the webinar, your lines will automatically be muted, but if you have questions to the panel, please submit them using the Q&A function. If you're having any problems with the sound, let us know via the chat function. So that's questions via the Q&A function and technical problems via the chat function. We will at certain points have an opportunity to deal with questions, but please do just ping them in through the Q&A, and anything that we can't deal with during the course of the webinar, we'll be in touch with you afterwards. So without further ado, I'd like to pass over to my colleague Mark Spencer, who's going to kick off the technical content. Mark.
David, thank you. And a good morning to everybody from me. I'm Mark Spencer, and I lead our financial services accounting advisory practice at BDO. First of all, thank you from me for joining us today for this webinar. Financial Services Accounting Advisory at BDO spans all sectors of accounting and financial reporting across 5 pillars: accounting change, structuring advice, financial instruments accounting and reporting, climate and corporate reporting, and all other areas of accounting, with insurance contract accounting and IFRS 17 falling under accounting change and structuring advice. One thing that the Financial Services Accounting Advisory team at BDO has been doing over the years, as with our colleagues in the assurance practice and the actuarial practice, is engaging with regulators in the UK and the EU, trade bodies, our peers both locally and internationally, and other parts of the wider community on the implementing of IFRS 17 insurance contracts. In terms of agenda, for the time that we have today, we will first be providing some context on the reasons behind IFRS 17's development and where we are in terms of the implementation timeline. We will then focus our attention on a large number of changes that IFRS 17 brings about in terms of recognition and measurement, presentation, and disclosure of insurance contracts. Finally, we will spend some time on P&I specific considerations that you should be thinking about. Having said this, the points on the changes that IFRS 17 bring about as a whole are relevant for P&I clubs, hence why we'll be talking through them. Next slide, please. IFRS 17 has been 20 years plus in the making. IFRS 4 was a stopgap that was drafted as insurance contracts needed a financial reporting standard when IFRS was adopted by the EU in 2005. Colloquially, IFRS 17 was known as IFRS 4 Phase 2 for a period of time. IFRS 17 was finally issued in May 2017. However, after 5 IFRS 17 Transition Resource Group meetings, deliberation at a European Union level and other fora, the International Accounting Standards Board agreed to amend aspects of IFRS 17 and did so over the course of early 2020, issuing the final amended standard in June of this year. The raison d'etre of IFRS 17 is to standardize the accounting and financial reporting of insurance contracts for those entities that apply IFRS. The effective date of IFRS 17 is now annual reporting periods beginning on or after the 1st of January 2023. However, unlike IFRS 9 financial instruments, IFRS 15 revenue from contracts with customers, and IFRS 16 leases, IFRS 17 requires the restatement of comparatives in the 31st December 2023 financial statements. This means that In those 31st December 2023 financial statements, one will need to show the effect of IFRS 17 as at 1st January 2020, which is the same financial position as at 31st December 2021. So, in the grand scheme of things, while 1st January 2023 seems a fair way away, the clock is ticking in terms of the large amount of work that needs to be done. Early application of IFRS 17 is permitted, but it needs to be endorsed before one can if IFRS is subject to endorsement in that jurisdiction. Before we move on, a word on UK GAAP. The Financial Reporting Council has said that it will review IFRS 103, which is the UK GAAP insurance contracts financial reporting standard, when IFRS 17 has been applied for a few years. I would take this to mean that the Financial Reporting Council will look at IFRS 103 in 2026. I would also expect that the Financial Reporting Council will introduce a fair amount of IFRS 17 into UK GAAP, with the what and the how much needing to be deliberated. Next slide, please. IFRS 17 has been developed as IFRS 4 does not provide information to the users of financial statements, particularly those who do not work in the insurance industry. And when I refer to information to the users of financial statements, I mean within the context of IFRS, which is problematic, as within the context of IFRS as a financial reporting framework, financial position and performance of an insurer may not be understandable, relevant, reliable, and/or comparable with entities in other industries. With this lack of comparability being felt across different insurers which are the same type and operate in the same jurisdiction, let alone different types of insurers across jurisdictions and when compared to non-insurers. Next slide, please. This is because, as you should be aware, IFRS 4 did not prescribe the accounting for insurance contracts, as do other standards, such as IAS 39, Financial Instruments, Recognition and Measurement does for financial instruments. IFRS 4 allows insurance contracts to be accounted for as they were being accounted for as at 2005 and onwards, with changes only being allowed if it gave rise to accounting and financial reporting that was more reliable and/or relevant, but not less reliable and/or less relevant. What is on your screen at the moment is a typical income statement that starts with the top line of gross written premium. Gross written premium is the premium that was written in the insurance contract. It does not represent earned income or premium received. The manner in which one gets from gross written premium to net earned premium is different across insurers. For example, it can include receipt of deposits. More importantly, it is different as to how revenue is earned when compared to other industries. Claims can also include payments relating to or refunds of deposits. With lots of aspects being rolled up into claims, reinsurers' share thereof, acquisition cash flows, and changes generally in insurance contract-related balances. This makes it very challenging to compare and analyze insurers' financial performance, as we said at the start. Next slide, please. And under IFRS 4, the balance sheet also includes a number of line items that relate to insurance contract-related transactions and balances. These include acquisition costs that have been deferred, premiums receivable, reinsurance contract assets, and a large number of technical provisions, such as claims incurred but not reported, claims incurred, unearned premium reserve, and unexpired risk reserve. Most of these balances are not discounted. Next slide, please. We will now talk through the income statement and the balance sheet in an IFRS 17 world. We will do so with IFRS 17's main measurement model in mind, which is quite simply referred to as the general measurement model. Santi will talk about the simplified model that is better known as the premium allocation approach. We appreciate that a large portion of the insurance contracts written by general insurers and P&I clubs will probably be eligible for simplified measurement under the premium allocation approach. However, we are covering the general measurement model as it is less likely that the reinsurance contracts held or reinsurance contracts written will be eligible for measurement under the premium allocation approach. IFRS insurance contracts written requirements apply in the same manner to reinsurance contracts written, with there being some differences for reinsurance contract held accounting, which we will come to later. Also, the standard recognizes that insurers issue a large number of insurance contracts, so the unit of account to which the standard's recognition and measurement requirements are applied is typically at a group of insurance contracts level. Santi will spend some time on requirements relating to group of insurance contracts, but what I am talking through applies equally to both individual insurance contracts and groups of insurance contracts. The IFRS 17 income statement looks very different. This starts with the top line of insurance revenue, which is recognized and measured under a more prescriptive, principles-based approach that is based on the International Accounting Standards Board model of revenue recognition that is similar to that of IFRS 15. Insurance revenue represents the earnings of premium for insurance risk over the life of the insurance contract. That is to say, it excludes compensation for the time value of money and other financial risk. The expected future cash flows on writing of the insurance contract are discounted to present value, and the difference from the premium received is reserved on balance sheet if the insurance contract is profitable. Losses, similar to IFRS 15, are recognized immediately in profit or loss. The locked-in profit is earned on a systematic basis over the life of the insurance contract via reference to the provision of insurance coverage under the insurance contract. This systematic basis is one that is quantified in the form of coverage units. So, say you have two 5-year single premium contracts within a group of insurance contracts whereby each year is a coverage unit, then this means that you have 10 coverage units in total. 5 for the first contract and 5 for the second contract. 2/10 of the unearned profit is earned each year and reclassified from the balance sheet to insurance revenue. However, if one of the policyholders were to cease to exist in year 3, then in the third year, one would recognize 4/10 of the unearned profit, which is the 1/10 on the first insurance contract and the remaining 3/5 associated with the second insurance contract. Santi will talk through some other aspects of coverage units later on in this presentation. Changes arising from the discount used at initial recognition due to the existence of time value of money and other financial risk is not associated with the provision of insurance services and therefore insurance revenue. This is recognized in a new income statement line item that is known as insurance finance income and expense, which sits outside of the insurance service result. This is because the profit that the insurer would earn for the provision of insurance service for insurance risk is to be determined at initial recognition and is to subsequently be recognized with all other variables held constant. Or, put another way, the margin for providing services under the insurance contract is locked in. The other component of the insurance service result is insurance service expenses. Cash flows that arise in acquiring the insurance revenue are recognized within insurance revenue. Cash flows that arise in servicing the claims, such as claims handling costs, are recognized with insurance service expense. Next slide, please. An IFRS 17 balance sheet has a line item for insurance contract liabilities that are made up of 2 items. The first is the liability for remaining coverage. This represents the discounted future cash flows for which the insurance service has yet to be provided by the insurer to the policyholder. If the insurance contract is onerous, then on initial recognition, one recognises the loss immediately in insurance revenue, so as that the discounted future cash flows that are on balance sheet represent the amount needed to perform the insurance services to the policyholder. If the insurance contract is profitable, then the difference between the premium and the discounted future cash flows are reserved on balance sheet as the contractual service margin. Debits to the liability for remaining coverage are recognised in profit and loss as the insurance revenue credits, to the extent they relate to the provision of insurance service or cash flows that were incurred in acquiring the associated insurance contracts. As I said earlier, the changes in the discount rate are recognised in profit and loss as insurance finance income and expense. When a claim arises, this is recognised as insurance service expenses in profit or loss, and liability for incurred claims on the balance sheet. This applies for both claims reported and claims that are incurred but not reported. So, the valuation of claims under IFRS 17 does not change in principle. However, if the duration to settlement of the claim is greater than 12 months, then this balance needs to be discounted as well. An asset for remaining coverage and an asset for incurred claims is recognised and measured for reinsurance contracts held on balance sheet. And financial assets will be accounted for under IFRS 9 and not IAS 39, as the effective date for IFRS 9 for an insurer is 1st January 2023. Next slide, please. And this slide brings together what we have been talking about in terms of IFRS 17's general measurement model for insurance contracts written and reinsurance contracts held, which is colloquially known as the building block approach, which is made up of building blocks of the future cash flows that are discounted, the risk adjustment, and if profitable, the contractual service margin. The discounted future cash flows represent what is known as the loss component, as this is what the insurer expects to lose at initial recognition, but this loss is reassessed each year, whereby the outstanding contractual service margin is reduced to zero before additional losses are recognised immediately in profit or loss. The risk adjustment represents compensation for the insurer for its bearing the uncertainty arising from insurance contracts in relation to the timing and the amount of the cash flows. The more uncertain the cash flows are, the higher the risk adjustment. This is not to be confused with the premium for liquidity, which is the time it takes to realise or settle a balance, with such premium for liquidity being part of the discount rate that is compensation for time value of money and other financial risk. And before I hand over to Santi, I'll just check in, David, to see if we have any questions from the audience that are pertinent to answering us at this point in time. David.
Thank you, Mark. We have a couple of questions, one of which I think we need to revert individually to the questioner, which is about comparing IFRS 4 and IFRS 17 on a kind of line-by-line basis. But one which is, I think, useful to reconfirm, although quite simple to reconfirm, is could you reconfirm the first date at which an IFRS 17 compliant balance sheet would be needed?
Right. The first date that an IFRS compliant balance sheet would need to be presented is in the 31st December 2023 financial statements if your year end is December. So I'm aware that P&I clubs have a year end of February, so that would be February 2024. However, having said that, IFRS 17 applies retrospectively. So that means you would also need to restate your prior year balance sheet and your opening retained earnings associated with that balance sheet. So that means you would need to show the adjustment at 1st March 2022, and you would need to present an IFRS 17 balance sheet at 28th February 2023.
So the answer, I think, is 22 and 23. but it's in the context of your 23 financial statements.
Correct.
Thank you. I hope
I
that
would
answers the question.
I hope so too, and I'll now hand over to Santi.
Thanks, Mark. So I'm Santi. I'm one of the directors in the actuarial team at BDO. Most of you probably already have come across me in the past few years. So I'm going to talk about the building blocks as Mark introduced in the previous slide. And we're going to start with the present value of future cash flows. Now, cash flows included in this block should be all insurance contract related cash flows within the contract boundaries. Now, the definition of what an insurance contract is and its contract boundaries is a complex area. And I will not go into the details today, but I would caution that the contract boundaries in IFRS 17 are not necessarily aligned with those of Solvency II. Then, okay, the future cash flows within the boundaries are then, so the premium and related cash flows, claims and benefits, expenses, and here you get both the allocated and the unallocated expenses, which means you've got the claims handling expenses, but you also have fixed and variable expenses that are attributed to fulfilling insurance contracts. Other cash flows are the acquisition costs directly attributable to the portfolio, also premium taxes and claim recoveries where you have subrogation or salvage. These cash flows need to be included in here. Now, because acquisition cash flows are included within the cash flows, then there is no deferred acquisition costs as in the current standard. Although acquisition cash flows in respect of future renewals can be recognized as an asset or liability until the company recognizes the contract renewals. Now, the estimate of cash flows should be an unbiased best estimate, and this means they need to be a probability weighted average of all possible scenarios. And for very complex liabilities, there may then need to be a need to use a stochastic model. These cash flows should also be current. That is, they need to be updated to reflect changes in views about likely outcomes. And finally, they need to be discounted for the time value of money. Now, the discount rates that are used or that you should use to discount these cash flows are not mandated as in the case of Solvency II. The discount rate should, however, reflect the nature of the insurance liabilities in terms of risk and duration. They should also be current and market consistent, which means they should be derived from observable market prices. And the rate of return of your, let's say, investment assets, of your investment portfolio should not come into the determination of the discount rates if the liabilities themselves are not indexed to these, which is unlikely in your type of business. The standard describes two approaches to determine suitable rates. There's a bottom-up approach and a top-down approach, but I won't go into further details about these approaches, mainly because for the majority of general insurance liabilities, a rate other than the risk-free rate would be admissible. Therefore, you don't need to think about liquidity adjustments to the base risk-free rate, etc. And this is generally because the uncertainty in timing and amount of general insurance claims is quite volatile. So, next slide, please. Next up is the risk adjustment. So the risk adjustment represents the compensation required by the insurer for bearing insurance risk. This adjustment is currently embedded in the liabilities, but without it being visible to the users of the accounts. IFRS 17 now requires us to make it explicit. It is in some ways the equivalent of the Solvency II risk margin or the current margins for prudence. IFRS 17 does not mandate a method by which to calculate the risk adjustment. Each entity can select a method that they think is suitable. However, if they do use a technique that is different to the confidence level technique, you're required to disclose the technique used or your methodology and the corresponding confidence level so that users of the accounts can benchmark with other companies. Now, there are a number of characteristics that the risk adjustment should reflect. For instance, low frequency, high severity risk should have larger risk adjustments than high frequency, low severity ones. And also similar contracts with longer durations should show higher risk adjustments than those with shorter durations. So in short, the risk adjustment reflects the appetite of the insurer for insurance risk, and this should be consistent across lines of business internally, meaning riskier lines of business should have higher risk adjustments than more stable ones. Now, the risk adjustment is expected to be reflected into profit and loss over the life of the risk, in line with risk exposure. So this means that as time goes by, the inherent risk reduces, and so should the risk adjustment. So for example, if you have a 5-year contract with a tail that extends 10 years from inception of the contract, then the risk adjustment should run off over the 10 years. Next slide, please. So now I'm going to talk about the contract service margin. And the contract service margin is that part of the premium that is not part of the claims and benefits, and that is in excess of the risk adjustment and the acquisition costs. It is the other element of deferred profit, talking loosely, alongside the risk adjustment. On recognition of the contract, it is effectively the balancing item at inception such that no profit is recognized on day one. And it represents the risk-adjusted unearned profit that will be recognized as the insurer provides services in the future. And it is assumed that the insurance company provides its services while the policy is in force. So for instance, and using the same example as before, if you have a five-year contract with a tail that extends 10 years from inception of the contract, then the contractual service margin should be recognized as profit over the 5 years the policy is in force. If there are changes to the present value of future cash flows in respect of future service, that is the unearned exposure, then the contract service margin will take the hit from the change, in a way dampening the impact on the profit and loss. And this can obviously only continue until the contractual service margins become zero, and any subsequent deterioration in expected future cash flows will be reflected in the profit and loss. Now, the concept of coverage units is introduced in IFRS 17, and coverage units, what they effectively do is unitize the contractual service margin so as to identify the portion of it that needs to be released as profit during each period. The standard does not specify how to determine the coverage units, and this has generated some debate, and this debate is documented in several TRG papers. Next slide, please. Now I'm going to talk about aggregation of insurance contracts. And in IFRS 17, there are two aggregation principles. There's the aggregation for measurement of the blocks that I have just described. And then there is the level of aggregation for the presentation of insurance information in the accounts. So I'll start with describing the measurement of blocks. So IFRS 17 conceives a portfolio as a collection of groups of contracts. And the groups within the portfolio are formed by contracts that are subject to similar risks and are managed together. And each of these groups consists of contracts that are issued no more than a year apart. The blocks described in the previous slides will be measured for each of these such groups that compose the overall portfolio. And there will be three types of groups. There will be onerous groups, there will be groups that are unlikely to become onerous, and there will be the rest. And by onerous, IFRS 17 means that the net cash flow within the contract boundary, including the risk adjustment, is estimated to be a net outflow. Now, in practice, there is bound to be a little distinction between unlikely to become onerous and the rest buckets. And you can create more buckets if you like, but IFRS 17 requires you to just create groups and allocate groups to each of these three, let's say, buckets. Now, measurement for insurance contracts and outwards reinsurance contracts is to be done separately. And all the considerations that apply to your inwards business apply to the reinsurance contracts as well, with a few exceptions. And these exceptions mainly apply to the onerousness principle and the contract service margin. And I think later on we'll go into a little bit more detail about that. And there are a number of complexities around reinsurance, which we will not cover today, because to discuss these in the detail that they merit would take a very long time. Now I'm going to talk about aggregation for presentation. And this concept relates to how the information is presented in the notes to the accounts. And that is the P&L and the roll forwards. The main change introduced by IFRS 17 is that direct business and outwards reinsurance need to be shown separately. That is, you will need roll forwards and P&Ls separate for inwards and outwards, and both of these need to be disclosed. Otherwise, there is no significant change between what is now required and what has previously been the case. And for that, the precise guideline is in IS1, and groups for disclosure are described in such a way that they should reflect material segments of the business. And these could either be the type of contract, so you separate life and non-life, or in P&I world, you could separate charters and non-charters and FDD, for instance. You have geographical area. It's another way you could split it. So US, Europe, Asia, etc. And a reportable segment. Now, the guiding principle is that aggregations or disaggregations of information should not obscure useful information, either because you include a lot of insignificant detail or because you've aggregated items that have different characteristics. And with that, I will hand back to Mark, who will continue showing you around the disclosures of IFRS 17.
Actually, Santi and Mark, can I just interject with a couple of questions that arise out of that last segment? Yeah. Santi, are you still on? One easy and quick question. Does the risk adjustment apply separately to gross claims and reinsurance claims? And I think the implication of that question is, can you deal with it net, either in calculation or disclosure terms?
No, you cannot.
That's nice and simple. Okay. And a follow-up question, which is slightly different. This is on the CSM, the contractual service margin. If you're looking at a single year contract, such as P&I clubs actually write, how does what you've explained work out? And I think the question really is about amortization of the CSM, Santi.
Yeah, well, for a one-year contract, the concept will still apply. Say if you are reporting on a quarterly basis, that means you have, let's say, discrete coverage units. As Mark explained at the beginning, he said the coverage units, example he did was a coverage unit per each year. But if you do it quarterly, you have a coverage unit for each quarter. Now, if you just report once a year, say each 20th of February, then those in the interim, there will be that happening, of course, but then you perhaps at the end of the year, you will have released all that contract service margin into profit anyway. So it depends on how you do the reporting, but the principle applies for a one-year contract. And later on, I will talk a little bit about the premium allocation approach, which simplifies this quite significantly for one-year contracts or contracts that meet the eligibility criteria.
Thank you very much, Santi. That's great. I think I interrupted. Back to you, Mark.
Thank you, David, and thank you, Santi.
Sure.
And now we're going to talk through the disclosures that need to be prepared and disclosed in an IFRS 17 set of financial statements. This arises from the fact that the income statement and balance sheet are simpler in terms of presentation. However, the detail then manifests itself in various forms and components, with an insurer needing to collate the data needed and have the systems and processes in place to be able to adhere to the requirements of the standard. So this slide shows the disclosures required for the liability for remaining coverage for existing business. The requirement is to show a roll forward for the change in the building blocks of the present value of future cash flows, the risk adjustment, and the contractual service margin from the beginning of the period to the end of the period. And this is to be further disaggregated in terms of past service, current service, and future service. So experience adjustments need to be assessed as to whether they relate to past, current, and future service. Past and current experience adjustments are recognized in profit or loss in the period in which they arise, while experience adjustments for future services are recognized on balance sheet. An assessment needs to be performed when the experience adjustment relates to both past and future performance, or current and future performance, with this being accounted for accordingly. The impact of changes in the present value of future cash flows and the contractual service margin under the general measurement model also impacts insurance finance income and expense. In the case of the contractual service margin, this is because, as said previously, the difference in the locked-in discount rate when compared to the current discount rate, that is to say the accretion of interest on the contractual service margin, is to be reflected in the insurance finance income and expense, not insurance revenue, while all other changes in financial variables are recognized in insurance finance income and expense. It is currently being debated as to whether the need to lock in the discount rate under the general measurement model necessitates the need to also lock in all financial variables that are associated with that locked-in discount rate when it comes to the contractual service margin. The effect of reinsurance contracts held is to be presented separately, and the carrying amount thereof needs to be estimated separately, with it having its own contractual service margin, its own risk adjustment, and its own discount rate. But reinsurance contracts written are to be treated the same as insurance contracts written. And this means that you can have income in terms of insurance finance income and expense, given it is probable that the financial variables on a reinsurance contract held will move in an opposite direction to the underlying direct insurance contracts that have been subsequently written and subsequently reinsured. It is worth pointing out here that there is a risk mitigation option in IFRS 17 that allows for the unwinding of the discount rate to be recognized in profit and loss under insurance finance income and expense on a systematic basis, while other changes that are in effect unexpected are recognized in other comprehensive income. The decrease in volatility in the profit or loss for risks that are not insurance risk related but financial risk related, and also allows for a degree of symmetry between financial asset accounting if these are measured at fair value through other comprehensive income. This is because under such IFRS 9 classification basis, changes in fair value due to changes in rates on said financial assets are recognized in other comprehensive income, with examples in changes in rates including those relating to foreign exchange, interest rate, and credit spreads for foreign denominated fixed rate bonds that are held, if that is what you are holding, as financial assets. The last line of the roll forward presents the cash outflow or inflow during the year, which can be due to either premiums being received, claims being paid, and so on and so forth. Next slide, please. Disclosures, and therefore information, is also required to be analysed for new business written during the year and experience adjustments, with experience adjustments taking the form of changes in estimates, and with this also including details by the present value of future cash flows, the risk adjustment, and the contractual service margin for profitable and onerous business written during the year. Changes in estimates for existing business also need to be analysed in terms of both profitable and onerous business as well, and for future service. Current service recognized in profit and loss needs to be disclosed, as well as experience adjustments for past service in relation to claims. Next slide, please. And on current service, this needs to be analyzed as well, so the information needs to be available. This is to provide insights to users on what has been recognized in profit or loss, with this being in terms of the contractual service margin earned, lapses, and adjustments for losses, which goes back to my point earlier of reducing any unearned contractual service margin when losses deviate adversely. Next slide, please. We have been speaking about the insurance service result a bit, but we will now turn our attention to insurance finance income and expense. As I said, under the general measurement model, interest on the contractual service margin accretes at a constant rate, and this applies to both insurance contracts written and reinsurance contracts held. Insurance revenue is recognized using the locked-in discount rate that was measured at initial recognition. The difference between the locked-in and current rate is the interest accretion and is recognized in profit or loss as part of insurance finance income and expense. This is the financing of the insurance contract by the insurer to the policyholder. Given the time value of money and other financial risk does not relate to the provision of services vis-à-vis the covering of that insurance risk. Furthermore, as I said earlier, assumption changes in terms of time value of money and financial risk from that which was expected and that which is observed can either be recognized in insurance finance income and expense or other comprehensive income, with this being an accounting policy choice, the outcome of which, if applied, is that the volatility due to changes in financial variables is reflected in other comprehensive income and not profit or loss, with only the accretion of the interest at the locked-in discount rate being recognized in profit or loss. Insurance finance income and expense needs to be analyzed by estimates of the present value of future cash flows and the contractual service margin. The risk adjustment affects insurance revenue as it is a direct effect of the uncertainty in the timing of the insurance-related cash flows, with this being more uncertain depending on the nature of the insurance risk and the insurance contract duration. Please remember that under the general measurement model, it is still being debated as to whether the locking in of the discount rate requires locking in and therefore tracking of all financial variables that are factored into the estimating of that discount rate. With such financial variables, including interest, inflation, and foreign currency, amongst other areas of financial risk that may influence the insurance contract written or the reinsurance contract held. Next slide, please. Cash flows also need to be analysed in terms of how they flow into the estimation of the insurance contract-related balances. For example, premiums received with IFRS 17 distinguishing between the treatment of premiums received and receivable. Another example is claims paid, which also includes the payment of other benefits and associated cash flows incurred in paying those claims and benefits, as well as insurance acquisition cash flows that are associated with the obtaining of the premium. These cash flows flow up into the estimation of the liability for remaining coverage and liability for incurred claims, and into the assets for remaining coverage and assets for incurred claims when it comes to reinsurance contracts held. The fulfillment cash flows are the discounted expected cash flows, which also includes consideration of the risk adjustment and acquisition cash flows. The contractual service margin is the difference between this and the actual premium received if the insurance contract is profitable. Next slide, please. This slide is just to remind you that insurance service result disclosures need to be analysed by insurance revenue and insurance service expenses, while insurance contract balances need to be analysed in terms of liability for remaining coverage and liability for incurred claims, with reinsurance contracts held being disclosed separately as is insurance finance income and expenses. Some additional thoughts on disclosure are, on reinsurance contracts held, it is being debated as to whether allocated reinsurance premiums can be presented together with insurance revenue and recoveries, together with insurance service expenses from the underlying issued insurance contracts, or as a single line item in the income statement. It is also being debated as to whether non-performance by reinsurers is financial risk or not, and therefore whether it is to be presented in insurance revenue or insurance finance income and expenses. This is because non-performance is being seen as being specific to the parties, and this being highlighted separately from financial risk in part of the standard, but being part of financial risk in other parts of the standard. Furthermore, the treatment of dispute is also being debated. Given IFRS 17's requirements on initial recognition, there is also debate on whether there is a requirement in IFRS 17 to present pre-coverage liabilities together with insurance contract liabilities. And this is because IFRS 17 has requirements on when insurance contract liabilities are recognized in terms of the policyholder being covered, the premium being due, or the insurance contract being onerous, with an insurance contract liability only being recognized at the earliest of these 3 dates. Next slide, please. This slide just summarizes what we have been talking through over the last 5 slides or so. However, one also needs to reconcile the liability for remaining coverage in terms of cash flows, excluding the loss component and the loss component. And as one can see, there is a large number of reconciliations that need to be prepared under the general measurement model, and an insurer needs the data, systems, and processes in place to deliver this. I will now hand back to Santi, who has a few more thoughts on other aspects of the standard. Santi.
Can I just interject again before we move just with a couple of quick questions?
Sure.
One of which is general, in other words, not P&I Club specific, and that is in relation to the determination of whether a contract is onerous. Are you allowed to include the impact of reinsurance when determining whether a contract is onerous? Is the question, and I read that to mean, can you deal with it net, or do you have to do the inward contract and the reinsurance outward separately?
You need to do them separately. We're touching on the interplay between insurance contracts written and reinsurance contract held later on in the presentation. But you do need to recognise, measure them, present them, and disclose them separately under the requirements of the standard.
Thank you, Mark. And we have 2 or 3 other questions that are very P&I Club specific, but as we have a few parts of the presentation which are very P&I Club specific to come, I'm going to hold those till then, if that's okay. Back to you, Santi.
Thanks, David. So I'm now going to talk about the premium allocation approach. Next slide, please. So the premium allocation approach is a simplified model that is for eligible insurance contracts only. To be eligible, the contracts need to have a coverage period of 1 year or less, or you can show that the premium allocation approach is a reasonable approximation of the general model. The liability for remaining coverage then becomes something similar to the UPR less DAC, which is something we can all relate to and much simpler. And there is more good news, which is that the liability for remaining coverage earns as revenue in a similar way as in the current IFRS, that is, in a straight line or in relation to the expected timing of incurred claims. And the IASB has included the premium allocation approach in recognition that for general insurance contracts, the analysis of unearned profit in locked in new business is less important than for life insurance contracts. And then under the premium allocation approach, you will also have some additional choices. So you can opt out of discounting the liability for remaining coverage, but only if at contract inception, the time between providing each part of the coverage and the related premium due date is no more than a year apart. And you can also opt out from discounting the liability for incurred claims, but only if claims are paid within a year of them being incurred. Next slide, please. So it is a simplified model, mainly because the contractual service margin is not a consideration. And there is no need to disclose fulfillment cash flows and risk adjustment for future service. However, there is still a need to identify onerous groups of contracts. And this necessarily means that you have to have an estimate of fulfillment cash flows behind the scenes, because this is how the test of onerousness is defined. The liability for incurred claims is the same as for the general model, which is it needs to be discounted, it includes a risk adjustment, and is the present value of all future cash flows. It needs to be shown at a best estimate, that means a probability weighted average basis. The requirement for separate gross and reinsurance disclosures, unfortunately, still applies, and all the difficulties with reinsurance contracts still remain. Next slide, please. Now, even if the premium allocation approach is a simpler model than the general model, there is still considerable disclosure required. So, for instance, the revenue and expense reconciliation shown in this slide will still need to be performed. Naturally, the roll forward that bridges the insurance contract liabilities between periods via the changes in the building blocks is not required. So now I'll hand off to Mark and David for the remaining of the presentation.
Thank you, Santi. Next slide, please. This slide summarizes most of what we have been talking about. On reinsurance contract held, what I would like to say is that an exception to the general measurement model is that a gain on a reinsurance contract held can be recognized in profit or loss upon initial recognition to the extent that it is not greater than the loss on the underlying direct insurance contract written if that reinsurance contract held meets the definition of proportionate under IFRS 17. And the definition of what is a proportionate reinsurance contract held is not necessarily that which is understood within the insurance industry, and we will come back to that later when we are looking at pooling arrangements and the Hydra. A loss recovery component is recognized on balance sheet for reinsurance contract held. However, this loss recovery component is still based on the contractual terms of the reinsurance contract held. That is to say, only in relation to the risk that it covers vis-a-vis the underlying direct insurance contracts written that it is associated with. And given that it is with a different party from that of the policyholder, so that means it's between the P&I club and the reinsurer, the discount rate and the risk adjustment could be different because the risk associated with the reinsurer not performing is different to that of the insurer not performing to its policyholder. Another point on reinsurance is that premiums that are not yet due but relate to past service are to be recognized in insurance service expense, given they form part of the liability for incurred claims as the insurance services have already been provided. Or, put another way, they follow the associated cash flows that have been recognized in insurance service expense. Finally, on reinsurance contract held, a high degree of judgment needs to be applied when following the premium allocation approach for said reinsurance contracts held. On acquisition cash flows, what I would like to say is that these need to be deferred if the contract's duration is more than a year or the general measurement model is being applied. These can be expensed if incurred under the premium allocation approach and the duration is less than a year. They can also make up a group of insurance contracts onerous as they form part of the future cash flows. Next slide, please. We will now turn our attention to P&I Club specific matters, and I will now hand over to Alex, who will set the context in terms of the relevance of IFRS 17 and P&I Clubs and how they operate.
Thanks very much, Mark. So I guess the key things for P&I Clubs to be thinking about right now. Firstly, what areas of their groups are going to be affected by IFRS 17 first? And the way it is very clearly going is the branches in Hong Kong and the Singapore will be affected. And then also a lot of Brexit locations are going to locations which require IFRS reporting. So those elements of the groups are going to need to move to IFRS 17. And then there's the question as to what extent do P&I clubs want to move their whole groups onto IFRS 17 if they've got some elements, particularly Brexit locations, which are going to have quite a lot of the underwriting. There's advantages and disadvantages around this, particularly around some of the complexity within some of the other parts of the group. But clearly, having one common reporting framework might be easier for consolidation and transparency. And then the next thing which P&I clubs need to really think about is what measurement model do they want to apply. So clearly, the premium allocation approach would be much simpler. But there's a number of nuances which Mark's going to talk about that currently may require the general measurement model, which clubs need to think about, particularly around the reinsurance arrangement. So Mark, passing back on to you.
Thank you very much, Alex, for that. We will be presenting some matters on which IFRS 17 requires thought and some considerations thereon. These areas include aspects relating to the capital structure of P&I clubs, the sharing of losses, and a couple of concepts in terms of measurement. Firstly, IFRS 17 has a very narrow concept of what constitutes a mutual, and is not what is known within the insurance industry. IFRS 17 mutualization is restricted to accounting for insurance contracts that have direct participation features under which the policyholder is entitled to the majority of the returns on underlying assets and the insurer is entitled to a fee. Such contracts are in effect those that have both savings and investment components, and the policyholder cannot lose more than what they pay in. Furthermore, IFRS 17 mutualization is restricted to 100 participating funds, where the policyholders as a result own the fund as policyholder investor, and policyholders are treated the same. This treatment would therefore in effect not apply to P&I clubs, as these important requirements are not met. Another way of looking at why the variable fee approach and therefore mutualization will not apply to P&I clubs is, while there may be surpluses, there can also be deficits in any given year of account. These deficits need to be made good for, and the manner in which they can be made good for is either by virtue of capital calls or the utilization of undistributed surpluses that have been brought forward from previous years, with this being discretionary. There is also an added complication when members change. This is because while the coverage under the insurance contracts have ended, the manner in which IFRS 17 is written is that parties acquiring an insurance contract need to assess whether they are in substance providing coverage, with this insurance taking the form of covering potential future claims and adverse deviations on those claims. This means that different members could be accounting for the same transaction differently, whereby one has a liability for incurred claims only, but another has a liability for remaining coverage and a liability for incurred claims. Next slide, please. Another nuance is that there are no premiums paid for the provision of service between P&I clubs, and therefore no premiums received. As I said earlier, an insurance contract can be recognized from when the policyholder is covered, the premium is due, or the insurance contract becomes onerous. As premiums are not received, then they cannot be due. This could have implications as to when the insurance contracts could be recognized between P&I clubs, which could give rise to a mismatch in terms of recognizing the underlying insurance contract with, say, a shipping company, and the subsequent internal reinsurance contract thereon under the pooling arrangement. This is dependent on whether any of the other recognition criteria are met and may require insurance contracts to be considered on a case-by-case basis. If an insurance contract between the P&I clubs cannot be recognized under IFRS 17 until a later point in time, then one-sided risk and therefore volatility will be recognized in profit or loss. Also, as I said earlier, reinsurance contract premiums that relate to past service are recognized in insurance service expenses. This point applies to reinstatement premiums, as these are, under IFRS 17, considered to be part of the current reinsurance contract held boundary and not representing a future reinsurance contract. Whether these reinstatement premiums are voluntary or mandatory is not relevant to the application of IFRS 17. The resharing of losses and associated contributions is also not considered to be a repricing of insured risk when it is done at predetermined rates. This is because repricing under IFRS 17 when determining when one insurance contract ends and another begins requires the reassessment of the underlying risks as at that later point in time, and the price being set accordingly based on those underlying risks. These two scenarios will mean that insurance revenue will not be recognized in profit and loss. Rather, the cash flows would flow through the insurance service expense line. Furthermore, P&I clubs would need to consider what they have in effect have rights to and obligations for in economic substance terms with respect to various parts of the P&I club structure and transactions, and then account for them accordingly. This could mean that there may be a need to consider, for example, joint venture and joint operation accounting under IFRS 11 joint arrangements, given the pooling arrangements, or silo accounting under IFRS 10 consolidated financial statements, given the existence of Hydra, which we'll come on to in a few slides' time. Next slide, please. Moving on to the internal insurance structure. Firstly, we understand that a P&I club retains parts of the losses and therefore needs to account for the insurance contracts written accordingly under IFRS 17's requirements and principles that we have outlined. For losses above the retained amount, then the concept outlined in terms of interest, contributions, premiums, contract boundaries, and the acquiring of coverage for future losses would require careful consideration, with this depending on whether one is looking at the pooling arrangement or Hydra per se. We will provide some thoughts for you to consider on both of these on the next couple of slides. Anything over and above the pooling arrangement or Hydra is a reinsurance contract held, which is accounted for under IFRS 17's requirements and principles that we have outlined previously when providing thoughts on reinsurance contract held. Next slide, please. On the pooling arrangement, IFRS 17's definition of proportionate reinsurance is not the same as that which is commonly understood within the insurance industry when it comes to reinsurance contracts held. Remember, reinsurance contracts written are treated as insurance contracts written under IFRS 17, with this also including internal reinsurance. This means that the various types of reinsurance contracts held would need careful consideration, as some proportionate reinsurance contracts held may not constitute proportional reinsurance contracts held, while some non-proportionate reinsurance contracts held may constitute proportionate reinsurance contracts held under IFRS 17. Furthermore, the terms and conditions of the reinsurance contract held need to be considered in terms of measurement model approach, whereby some reinsurance contracts held may not be eligible for the premium allocation approach given their terms and conditions. For example, the coverage period is greater than 1 year and the application of the premium allocation approach would not materially give the same outcome of the general measurement model. These two factors, that is, to saying whether the reinsurance contract held is proportionate or not for the purposes of applying IFRS 17 and the measurement model that applies, could give rise to differences in performance recognition, with the general measurement model being applied to the reinsurance contract held and the gain on the reinsurance contract held not being reflected immediately in profit and loss against the loss that arises on the associated insurance contracts written at initial recognition, but reserved on balance sheet as part of the asset for remaining coverage, given that the reinsurance contract held is not proportionate for IFRS 17 purposes. Regardless of this, a net gain cannot be recognized at initial recognition under the IFRS 17 standard for IFRS 17 proportionate reinsurance contract held. That is to say, anything over and above the loss on the underlying insurance contracts written is deferred on balance sheet for IFRS 17 proportionate reinsurance contracts held. Another complexity for P&I clubs is that their year ends are the 28th of February, but the insurance contracts may be effective on a calendar year basis. This lack of coterminousness will give rise to a greater number of insurance contracts having an effect on a particular P&I club financial year. Next slide, please. Moving to Hydra, each P&I club owns a cell within the Hydra Insurance Company Limited. For accounting and financial reporting purposes, this is a silo which is to be accounted for by the P&I club under IFRS 10 consolidated financial statement. The principle and requirements outlined in this presentation on insurance contracts written and reinsurance contracts held, both generally and specifically to P&I clubs, apply to Hydra as relevant, with the premium to participate needing to be accounted for in terms of what it relates to, including participation in the structure and insurance contracts. An added complexity is potential financial reporting framework differences if Hydra does not report under IFRS, with adjustments needing to be quantified and effective to transactions where needed, so as to align accounting policies at a P&I club level as part of consolidation of the silo in accordance with the requirements of IFRS 10. Next slide, please. Couple of considerations on some particular aspects that relate to measurement. Firstly, on what basis are claims recognized? For those claims that are recognized when notified, the insurance service would have been performed by the end of the insurance contract. That is to say, to the extent that the year of insurance contract is aligned to that of the P&I club, which end on the 20th of February. For those claims that are recognized when the losses occur, then insurance service would not necessarily have been performed by the end of the insurance contract. So there may be a liability for remaining coverage in the latter instance, but not in the former instance, with judgment needing to be exercised in such circumstances. That is, unless the insurance contract has been acquired for reasons related previously. Both scenarios will have a liability for incurred claims, with the principles and requirements outlined previously equally applying to said liability for incurred claims. Secondly, P&I clubs have recently been operating on a combined ratio in excess of 100%, with larger than usual risk margins being applied. Using a higher risk adjustment under IFRS 17 will decrease the liability for remaining coverage for an insurance contract written, which increases the likelihood of it being onerous as initial recognition when compared to the premium received from the policyholder, with that loss being recognized immediately on profit and loss. And in terms of, to clarify, how you determine whether an insurance contract is onerous or not, what you do is you forecast your future cash flows, you discount them to present value, you then apply the risk adjustment, and you compare that to the premium received. If the premium received is less than those discounted risk-adjusted cash flows, then the contract is onerous. If the premium received is greater than those discounted risk-adjusted future cash flows, then the contract is profitable and you have a contractual service margin. And finally, the margin could form part of the risk adjustment that is estimated under IFRS 17, but it needs to be assessed as to the extent that it reflects the requirements associated with risk adjustments that Santi outlined earlier. And I will now hand over to Alex, who has some key messages on IFRS 17.
Slide, please. So what do the clubs need to be thinking about right now? Well, first of all, training, making sure everyone understands what the new requirements are, particularly for those locations which need to apply IFRS 17. And then gap analysis is really, really important. So both on the numbers impact and also disclosure and various other aspects. And within that, thinking about the eligibility, the sort of eligibility of the premium allocation approach, particularly with these reinsurance structures, and what may need to be done for the reinsurance. For those reinsurance structures to make them easier. Then impact analysis is really, really important. Then developing your key methods and so on. And then data is going to be really, really important. Making sure you've got the right data, making sure it works with your accounting processes, because these things will change. And then you've got to think about your sort of reporting engines. It's different to Solvency II, it's different to current GAAP. So how is it going to work within your current processes? There's a real risk that IFRS 17 reporting just becomes one more form of reporting, particularly if you're not going to be able to apply it across the club as well. And then the governance structures. Everyone's got to understand this new sort of reporting. All your stakeholders, the members need to understand why the numbers are changing. If you want to apply this to the group as well. Risk management is going to sort of change because your numbers are going to be changing. And then you've got to test your sort of tools. You've got to develop those disclosures, which are going to be complicated, which are going to mean you've got to have the data and systems to support these disclosures and make sure they can be really, really tested as well. And the dry runs are going to be important. You need to do dry runs well in advance of the year end affected, particularly because you're going to have to restate numbers. So on the right hand side, importance of accountants and the real importance of actuaries within this. It's a completely new framework. It's complicated. So making sure your sort of guys understand it. Then training systems, data governance, all very, very important. It's a big step. Next slide, please. Mark, over to you.
Thank you, Alex. This slide just summarizes the differences between current accounting and IFRS 17's general measurement model and premium allocation approach. The liability for remaining coverage can broadly be aligned with the unexpired risk reserve, while the liability for incurred claims can be broadly aligned with the expired risk reserve. The liability for remaining coverage is made up of the four building blocks of the future cash flows, discount rate, risk adjustment, and contractual service margin, with the first of these three building blocks comprising the fulfillment cash flows under IFRS 17. Clearly, there is no contractual service margin under the liability for incurred claims. The premium allocation approach gives a broadly similar unearned premium less acquisition cash flows, with the liabilities for incurred claims needing to be discounted if their settlement period is greater than 1 year, and also risk adjusted. It goes without saying that these are the respective on-balance sheet positions. Next slide, please. There are resources for both accounting and financial reporting for insurance contracts and insurance more generally on our UK and global website. These include, for example, a bulletin to the International Accounting Standards Board's June 2020 amendments to IFRS 17, as well as our monthly insurance update. Next slide, please. There are our contact details on the screen should you want to discuss anything that we have covered today, or any accounting, financial reporting, corporate reporting matter further, as well as any matter relating to insurance. But may I remind you that the slides of this presentation will be made available, so you'll have them to hand. And on that note, I thank you very much for your kind attention. I hope that you found this useful and continue to keep safe and stay well. I think we now have a time for a few more questions. David.
Thank you very much, Mark. We haven't actually got very much time, but there are one or two questions which I think might be worth very quickly taking, partly because they come from someone who appears to be anonymous and therefore we won't be able to follow up directly afterwards. Can anyone comment on this? Based on our experience, roughly how much longer than a year can a coverage be for a contract to be eligible for PAA? And is it therefore likely that a 2 or 3 year contract might be eligible? I mean, I'll pitch in a little bit and see if anyone else can sort of add to this. It really depends on how level and how predictable the risk profile of the contract is, and therefore how similar the PAA result would be to the GMM result. Mark, do you want to add anything to that?
Yeah, the way we approach whether or not you can apply the PAA is to basically keep challenging yourself as to why you can't. And if you can no longer file an valid reason as to why you can't apply the PAA, then you probably can. Now, it depends very much on what the insured risk is. For example, if you're insuring the construction of a warship, then that risk increases as the construction of that warship or submarine increases. So in that space, you cannot just qualitatively say that the PAA is, you're eligible for the PAA. You would need to do some quantitative modeling to show that the application of the PAA does not give a materially different result to the general measurement model. So it very much depends on what the insured risk is in the first instance, and also, if needed, what the numbers show.
Thank you, Mark.
I might add to that, which is most general insurance contracts, regardless of their length, will most probably be eligible for the PAA, because the volatility on the liability for remaining coverage, how much that changes, it doesn't change that much. So, and to go to Mark's example, yes, the risk of building a ship might increase over time, but that will already be reflected on your expected value of the future, let's say the liability for remaining coverage, if you've done your calculations correctly. So that's unlikely to, you're unlikely to change your view. Something that will change your view, for instance, where perhaps not so applicable to you, but for some motor insurance could be Ogden rate changes. If that seems to be very, it changes very often, then the liability for remaining coverage can change quite unexpectedly. Otherwise, generally the liability for remaining coverage is quite, or your expectations of what it's going to be is quite stable. So I know that many GI companies are trying to push, and this is in the end is the test that the test that the auditors will make of this. But most companies are trying to push most of their contracts to be eligible for the PAA.
Thank you very much, Santi and Mark. I mean, we have a number of questions which are more specific, but I think we are running out of time. Correct me if I'm wrong there, anyone else?
We have until 11, David.
Oh, in that case, we can go a bit further. My apologies. Right, in that case, let me go back to for a very specific point about the premium allocation approach. How does this interact with a deferred calls approach, e.g., or i.e., say 80% in the first year and 20% in the second or third years?
It doesn't interact very much. So your revenue, your liability for remaining coverage. So this is just trying to get used to the new jargon of IFRS. The liability for remaining coverage will still be the same. You'll still recognize that revenue as earned. The 20% the delayed call will then become part of the liability for incurred claims as a cash flow, a premium cash flow that you'll need to recognize there and discount.
Okay, thank you, Santi. Now, here's one about the interaction of inward and reinsurance outward business. It's for a group of onerous contracts. Could you recognise the impact of reinsurance contracts at the same time if those reinsurance contracts start later?
The short answer is no. You would need to have the reinsurance contract in place. I mean, and this is an area that's been debated. I understand that insurers start writing insurance contracts and they're still negotiating the terms of the reinsurance contract. But unfortunately, you can only recognize a transaction for financial reporting purposes when you are a party to that contract. So you would have a potential mismatch there for a period of time.
Yeah, thank you, Mark. I mean, that's the reason for asking that question, I think, which is pinning it to an actual contract. Another one, will supplementary calls be classed as reinstatement premiums?
I think it depends in terms of what the substance of those supplementary calls are, and what they relate to.
Can I add to that then, Mark, and this might be one that Santi wants to pitch in as well. Overspill calls particularly.
I mean, if it's for the acquiring, if it's a case of the limit has been breached under the reinsurance and you're effectively making the call to have more reinsurance, then it could be classed as a reinstatement premium. If, however, it's a new contract, then it would be a new contract, so it wouldn't be a reinstatement premium.
Thank you, Mark. That's the principle. Santi, you were going to say something?
It's because it's triggered from claims experience that makes it be treated as a reinstatement premium. Yes.
Yeah, so that's the principle, really.
That's the principle. If it's triggered by claims, in this case, an overspill claim, yeah, definitely it will be that. And then, yeah.
Yes,
we're not talking about reinsurance here, but it will be the same principle. Yeah,
so if there's an adjustment on the premium due to a supplementary call because of a bad claims experience that the club experiences, then that would be an adjustment to the underlying premium, which affects the cash flows. So the profitability of the underlying contract, first of all, because you aren't reinstating a new contract with a lot of the supplementary calls, but you do also get deferred calls. So there can be nuances within each of the clubs and the way they deal with deferred calls and supplementary calls.
Actually, that highlights a very good point, which is that the answer to a lot of these questions is you need to look at the exact terms of what's happening. And that's a general feature that we've experienced a lot in trying to apply IFRS 17 to a wide variety of different circumstances. Further questions, as we have a couple more minutes. Is there no room for booking prudency on reserves in IFRS 17?
Well, before Santi says something, the more prudent you are, the more onerous contracts you're going to have.
Santi, any comments on the...
So my comment is you have to do, the cash flows need to be on a best estimate basis. You can put all the prudence you want as a risk adjustment because it reflects your risk appetite to that risk. So if you're really risk averse, go ahead. You can put as much as you like in the risk adjustment, as long as you respect the main principles of it needs to be released into profit over time, and that you put a higher risk adjustment for those riskier groups of contracts and smaller for those that are smaller. As long as you're internally consistent with your thought process in that regards, you can put as much prudence as you like. It's gonna be shown in the accounts. It's gonna be transparent. It's much like in Solvency II. Everyone who reads the accounts will be able to tell that you are really, really risk averse. And as Mark says, it will most very likely make all your contracts onerous, which, since you're a mutual, you're generally mutual entities, then it won't necessarily be an issue.
Thank you very much. A simple question, which I think I know the answer to, is have any quiz spreadsheets been issued for IFRS 17?
No.
The equivalent is, I think the answer is no.
No, and I think the main reason for it is that many of the elements within IFRS 17 are quite They're quite judgmental. You have to argue them. There's no one size fits all. The mechanics of the calculation to calculate, let's say, elements such as the CSM or let's say the discounting or all the different bits that the actuaries are going to have to calculate for you to be able to do those roll forwards. They are not that complex. Let's say I have kind of like a working prototype, but then the problem with that is if you release it, you might end up say be seen as providing advice or something, but no one has come out with this is the basic let's say spreadsheet that you need to follow for
I think that's right. Our experience is that it's just non-standard in that sense. That does lead on to a quite a wide question, really. What is the expected time frame and cost required to implement IFRS 17 for P&I clubs? And a supplementary to that is how many clubs have already initiated the processes required? Now, I don't know who wants to jump in there. It's a very wide question.
Yes, I'm happy to go first. Sorry, Alex, were you going to say something?
No, it's fine, you go for it.
I mean, as I'm sure you can understand and appreciate, IFRS 17 is a very challenging standard to implement, and it is going to take a fair amount of time to do so. So if you haven't started yet, I hope that one of the takeaways from this webinar is that you start thinking about how you're going to apply in IFRS 17. My experience generally of IFRS 17 implementation is it takes longer, and I'm not aware of an insurer who has finished implementing IFRS 17 yet. It takes longer than expected, and unfortunately, it only gets more expensive as time goes by. So what we're seeing in terms of for general insurers, life insurers, composites, is that the costs only go one way. It requires more resource, it incurs more hours, and that has a price with it.
Yeah, I mean, I think most of the clubs haven't gone too far down this route really yet. I think the key thing for me is to clear away the areas of complexity, and particularly those reinsurance structures, because a lot of the reinsurance structures might be able to be redesigned to be able to be much simpler and to make some of the general measurement model stuff much easier. So I think it's important that the clubs think about their own internal group reinsurance arrangements, think about the stop loss reinsurance arrangements if they use them, and then also the international group reinsurance arrangements, and just make sure from that perspective that it's going to be as easy as possible. Because once you start having to do the premium allocation approach for some policies and then something else for the reinsurance contracts, it becomes much more complex. So it's clearing away the easy stuff early, or the difficult stuff early.
And I would add to that the best way to know how to change those contracts or alter those things such that then they are easy to allow for an IFRS 17 is to actually start doing a gap analysis and start doing the process of implementation, because until you get stuck on the detail, you know what to do.
Thank you all. I think that's helpful. I think the general message, and I think our experience in other general insurers, is that actually it's possible to spend spectacular amounts of time and money and not get very far. And Alex's point about being very, very focused on the right approach and the most effective way of doing it, I think is absolutely right. Well, I think we're coming to the end of the webinar, and just a couple of final points, if I may. We may not have answered everyone's questions very specifically today, or as specifically as you may like, but we will be happy to revert in all cases after the webinar more specifically. And thank you for submitting the questions that you have. Mark, I think, highlighted all the contact details of everyone involved, and we are more than happy for direct approaches in terms of questions and further discussions. And as mentioned earlier, we have recorded this webinar, and we continue to do so, and we'll be sending you a copy of the recording and the slides over the coming days. So finally, I'd like to thank the team, Mark, Santi and Alex, for presenting today. And thank you for joining us this morning. And I wish you a good and profitable rest of the day. Thank you all.
Thank you very much.